Netflix is making one of the most important strategic moves in its history. It's a move that changes how the company operates, how much risk it takes, and how investors should think about the business going forward. The market didn't react well, and the stock has been under pressure. In this video, I want to explain what is happening, why Netflix is doing this, and whether this is a smart long-term decision or a risky bet in the short term. Please note that this is not investment advice, it's just my reasoning. And by the way, welcome to Rebuild Finance. On this channel, we break down single stock analysis with one goal: identifying valuable companies to hold for the long term and build wealth. If that sounds interesting to you, consider subscribing to follow the journey. You might ask yourself, what is happening? Well, the deal didn't appear overnight. It's the result of a long restructuring process and a very aggressive bidding war. And there are three main players in this story: Netflix, Warner Brothers, and the Paramount Skydance Group. The story starts in June 2025, when Warner Brothers Discovery publicly announced its intention to separate its declining cable television business from its studios and streaming assets. After the announcement, Warner obtained multiple offers from several entertainment companies to either buy the streaming segment or buy the whole company directly. In October 2025, Warner received a first offer from the Paramount Skydance Group at around $24 per share, valuing the company at roughly $60 billion. The board rejected it immediately since the price was considered too low. Around late November, the first formal round of bids took place. Paramount came back with an improved offer of around $25.50 per share. Netflix entered the process on this date with a higher bid, roughly $27 per share, with a heavy cash component. In December of 2025, the second round began. Netflix raised its bid close to $28. Paramount protested publicly, claiming the process was unfair and tilted in Netflix's favor, but Warner continued negotiations. On December 5th, Netflix was granted exclusive negotiating rights. The initial agreement valued Warner's core assets at $27.75 per share, structured as $23.25 in cash and $4.50 in Netflix stock. Over the following days, Paramount launched a hostile all-cash bid of $30 per share for the entire Warner Brothers Discovery Group, including the cable networks. Once again, the Warner board rejected the offer. In late January 2026, Netflix amended the deal to an all-cash offer at the same $27.75 per share. The goal was to remove any uncertainty related to financing or stock volatility and to simplify the overall process, since paying in stock would require additional regulatory filings and time. Shortly after, the Warner board formally approved the transaction, effectively sidelining Paramount. The contract between Netflix and Warner Brothers includes unusually large termination fees. First, Netflix would owe Warner approximately $5.8 billion if regulators blocked the deal. Second, Warner would owe Netflix about $2.8 billion if it walks away or accepts a superior offer. As of February 2026, the situation is clear. The Netflix deal is locked in. Pending approvals, a shareholder vote is expected around March or April, followed by antitrust reviews in the United States and Europe. If approved, the transaction is expected to close between the fourth quarter of 2026 and the first quarter of 2027. If the deal goes through, Netflix will get full ownership of Warner Brothers Pictures, Warner Brothers Television, HBO, HBO Max, and a massive intellectual property portfolio that includes DC Comics and Harry Potter. Before we talk about why they bought it, let's understand exactly what they paid. You might see headlines saying $68 billion and others saying $82 billion. Here's the difference, and it's crucial for understanding the risk. Netflix offered $27.75 per share. With about 2.5 billion shares outstanding, that gives us an equity value, the cash paid to shareholders, of roughly $68 billion. But that's not the whole bill. When you buy a house, you don't just pay the seller, you also take on the mortgage. Netflix is assuming the net debt associated with these studios estimated at around 14.7 billion. So, the total enterprise value is approximately 82.7 billion dollars. This is the real price tag for Netflix. So, the big question every investor is asking right now is why? Why is Netflix paying such a massive amount for this deal? Based on Warner's 2025 guidance, their studios and streaming segments combined generate roughly $3.7 billion in EBITDA, or earnings before interest, taxes, depreciation, and amortization. That means Netflix is paying a multiple of over 22 times earnings. For a media asset, that is unheard of. Usually, you pay 8 or 10 times. So on paper, this looks incredibly expensive. But if you look closer, this isn't just an acquisition. This is Netflix finally fixing the biggest flaw in its business model. For the last decade, Netflix has been trapped on what I call the content treadmill. They spend over $17 billion every single year to produce new shows just to keep you subscribed. But here is the problem. Most of that content has a short shelf life. Once you finish Squid Game or Stranger Things, you ask, what's next? If Netflix doesn't have a new hit ready immediately, you cancel. They were renting your attention, not owning it. By acquiring Warner Brothers, they stop renting relevance and start owning history. They are buying a century of culture. They get Harry Potter. They get the entire DC universe, which includes Batman and Superman. They get Game of Thrones, Friends, and The Big Bang Theory. These aren't just movies, they are forever assets. They generate cash flow for decades without needing to be remade. Essentially, Netflix is buying a library that secures their future forever. This deal effectively declares Netflix the winner of the streaming wars. Think about it from a consumer's perspective. If you combine Netflix's massive global subscriber base with HBO's prestige content, the value proposition becomes unbeatable. For competitors like Disney Plus and Amazon Prime, the gap just got impossible to close. If Netflix becomes the only app you really need, that gives them massive pricing power. They can raise prices again, and consumers will likely pay it because where else will they go? This transforms Netflix from a media company into a utility, similar to your electricity or water bill. You don't question it, you just pay it. Finally, the third pillar of this deal is good old-fashioned cost cutting. When you merge two giants like this, you find massive redundancies. Right now, you have 2 finance departments, 2 legal teams, 2 HR divisions, and 2 separate technology stacks. You have HBO Max running on its own expensive cloud infrastructure and Netflix running on its own. By consolidating everything onto Netflix's superior tech platform, they can shut down redundant systems and save hundreds of millions of dollars in overhead immediately. These boring back office synergies are often the easiest way to justify a high purchase price because they go straight to the bottom line. But we have to look at the other side of the coin. As a former auditor, when I look at this deal, I see some very dangerous red flags. And I'm not just talking about the $82 billion price tag. Netflix has spent years cleaning up its balance sheet. They were finally free cash flow positive and paying down debt. Now, to fund the cash portion of this deal, they are reversing all that progress. They are taking on tens of billions in new debt to pay Warner shareholders. This changes the risk profile of the stock entirely. They are moving from a pristine investment-grade tech company to a highly leveraged media giant. If interest rates stay higher for longer, that debt becomes very expensive to service. And if we hit a recession, that debt becomes a heavy anchor that could drag the stock price down for years. This is perhaps the biggest hurdle in the short term. Regulators in the United States and Europe are already very skeptical of big tech monopolies. Combining the world's biggest streamer with one of Hollywood's biggest studios creates a giant target. Remember those termination fees I mentioned earlier? If the Federal Trade Commission blocks this deal, Netflix has to pay Warner nearly $6 billion. Let me repeat that, $6 billion. That is shareholder money that would simply vanish for nothing. It's a massive binary risk that hangs over the stock until the deal closes. Finally, there is execution risk. Warner Brothers is a legacy studio. It has unions, old school executives, and a completely different culture than Netflix's Silicon Valley tech mindset. Merging these two giants won't be smooth. History is full of media mergers that destroyed value. Remember Time Warner and AOL. Netflix is betting they can integrate these assets seamlessly, but it is going to be messy, expensive, and distracting for management. So, is Netflix a buy right now? Here's my take. If this deal goes through, Netflix become the Google of TV, an unavoidable utility with immense pricing power. But in the short term, the stock is likely dead money. It's weighed down by arbitrage traders, regulatory fear, and a massive debt load. Personally, I am watching from the sidelines. I believe the stock still has room to fall. My plan is to wait. I will look to start building a position if it drops into the $70 to $75 range. Once it hits those levels, I will start buying in small quantities, dollar cost averaging, because I do not want to be overexposed to the massive execution risks we just discussed. What do you think? Is this a visionary move by Netflix or reckless spending that will crush shareholder value? Let me know in the comments below, and if you enjoyed this analysis, hit that like button and subscribe to Rebuild Finance. I'll see you in the next one.